subjective areas, whereas technical analysis go more onto price action, what price is saying, and the price ultimately telling about the psychology of the market participants. The main thinking is probabilistic. We think in risk reward. So, for example, according to us, if risk is more, reward is more, risk is less, we enter into that kind of trade in technical analysis. So, all the things are from a risk reward perspective. We want to focus on a more better risk reward perspective. There is some bits of what I say. There is some similarity between technical analysis and momentum investing. Both are kind of similar. We are not discussing this, but wanted to give some context. So this is what Investopedia is saying: study of historical data, including price and volume. So volume is the number of shares being traded, buying and selling. For example, if today in Reliance Industries 1 crore shares are being bought and 60 lakhs are being sold. So the total volume is 1 crore 60 lakh. So volume is also a very important thing because it tells about what the market is doing, what the people are, in the market are doing. Okay, so the first theory, there are also many theories before that, but the first most prominent theory is the Dow theory. So the theory was derived in Wall Street Journal editorials written by Charles Dow. He was a journalist, founder, whatever. So the main hypothesis is based on that stock market does not perform on a random basis. There are clear-cut patterns, and he suggests that these patterns, he called them as trends. And very important saying, trend is your best friend, which I earlier also said. So there are three types of trends. One is a primary trend, secondary, and a minor trend. Primary is the major happening if you see from a bigger perspective. And there are two primary trends, bearish and bullish. Also third one is also there, which is kind of sideways trend. Uptrend, sideways, down. Uptrend is bullish, downtrend is bearish. Then there are secondary and minor trends as well, but these are for shorter time duration and not as prominent as the primary. So this is that. So the theory basically said that pick up a appropriate time interval and draw a line chart. In that line chart, and there is a little subjective because we don't know what is the appropriate time interval. Some people say it's 1 day chart, some people say a lot of things, but depends on your perspective. So you identify major, there will be a lot of bumps in these, but you will identify some major patterns happening, and in that you identify lows and highs of the market. So for example, this is a low, this is a low, this is again a low, this is a low, and then you identify highs. This is a high, this is a high, this is a high. Then you see the relation between the highs and lows. If consecutively higher lows are being formed and higher highs are being formed, so this high is greater than this high, this high is greater than this high, and this low is greater than this low, this low is greater than this low. This is called a uptrend or a bullish trend. If there are sort of equal lows and highs, then it's a sideways trend. And if the reverse is true, that there is a consecutively lower highs being formed and lower lows being formed. So this low is lower than the previous low. This low is lower than this previous low. So that is a downtrend. Three trends: uptrend, sideways trend,